Good morning and welcome to the Haven Financial Group radio show. I'm Larry Kallevig, founder and CEO of the Haven Financial Group. Thanks for listening this morning. On with us today, we have Lance Larsen, our Haven CPA. We're going to talk about a lot of different things. It's 2026. And Kim, good to be with you again.
It's great to be with you, sir. Thank you very much. Yeah, we're going to talk about pillars of retirement in 2026. So good to have Lance with us like always. Lance, Happy New Year, sir.
Thank you. Same to you, Kim.
Great to see you. Let's take a look at what folks can expect during the course of this show. We're first going to talk about strategic gifting and the 2026 tax cliff. That doesn't sound very positive, does it, Larry?
Not really.
No, it does not. Inherited IRAs and the 10-year rule. And then we'll talk a little bit about health benefits and planning beyond investments. And then finally, we'll talk about preparing for 2026 with intention. So here we are, it's mid-month, but it certainly is not too late to consider what you have planned for the year 2026 and to take some steps to make sure that you're moving in the right direction when it comes to your retirement. If you have any questions about today, or if you hear anything that resonates with you and you'd like to sit down with the folks at Haven Financial Group, let me remind you of the telephone number. It's 612-504-8400. Let's jump right in, shall we? The strategic gifting and the tax cliff when it comes to 2026. Strategic gifting, Lance, I'm going to start with you, our CPA here. That's something you really do want to start to think about really early in the year, like January.
It is. So what we're kind of talking about is a lot more estate planning type ideas. On the federal level, the estate tax kicks in at $15 million. That's a new from the big, beautiful bill that was passed there. It's always been fairly high the last few years. We were just shy of 14 million last year. But yeah, now we have hit the 15 million at the federal level. For Minnesota, the estate tax is 3 million. And so what, again, we're talking about is that when you pass away, if the assets that you own, so it's an IRA, it's your house, it's the cabin, it's your cars, it's all the things that you have, if the total value of that stuff today is worth more than $3 million, then there's a good chance that you're going to be cutting a check. Your estate is going to be cutting a check to the state of Minnesota. So we want to make sure that we are planning correctly. And so one of the big things that we have is the gift that we can give to people. And the gift limit is going to be $19,000 this year in 2026. And so that is from one individual to another. So, Kim, I could give you $19,000 and we don't have to report that at all to the IRS, and it doesn't count against any of that lifetime exclusion. I can also turn around and give Larry $19,000 because I am such a nice person here. And I can keep giving $19,000 to any individual. Now, where this kind of comes in with a lot of planning is that we can actually start looking at parents giving to married kids. Mm-hmm. So mom could give their child $19,000. Dad can give their child $19,000. Mom could also give the spouse $19,000, and then dad can give the spouse $19,000. So right there, we have just given away $76,000 out of mom and dad's estate to their kids because that's where it was going to go eventually anyway.
Mm-hmm. And can I ask you, can you do that even if mom and dad file their taxes jointly?
Yes.
Okay.
And so then when we get to the gifting rules, we can have one spouse actually write the check out. But then there's a thing they call gift splitting where the spouse says, yeah, my spouse, they gave my half or my portion of this to these people, and I'm okay with that. Mm-hmm. And so that's what gift splitting is right there, is that, sure, mom may have wrote the check out for the full $78,000 to the child and spouse. And then the dad comes in and says, yeah, we'll call that gift splitting. So then half of it was my gift to them as well.
Okay, great. So talk about, obviously you could do this over a long period of time if you so desire to gift away your estate. What are the ramifications for those who are receiving that gift?
There's actually none.
Okay.
And so when you're receiving the gift, there is no tax implication for you at that point. So especially if you're giving cash, then cash is cash. You don't have to worry about anything.
Hmm.
There may be a little bit of issue when we start talking about gifting property,
Okay.
because at that point, the basis, meaning what mom and dad were into the property for, that basis transfers with the gift as well. So when you want to look at getting things out of your estate, so you have highly appreciated stock. So back in the day, Apple was worth maybe less than $1 a share. And so somebody might have been lucky and been able to buy it at that price. And now it is worth a lot more. So if that individual decides to sell that stock, they're going to recognize a huge capital gain. But instead, if we want to give it to our beneficiary, so if it's a parent giving it to the child, then we do that. Well, now that child inherits that dollar per share basis. So now the capital gain it will happen on the child. So this is one of the things that if you're a charitable person, you would actually look at probably giving that Apple stock to the charity to get it out of your estate.
Mm-hmm.
So again, a lot of variety of ways of going about doing this.
Mm-hmm.
But at the end, we just want to be careful of what we're doing and understand the tax ramifications on both sides.
Mm-hmm. So Lance and Larry, everybody's situation is going to be different. We've given a few examples of how this all works, and maybe this resonates with folks who are listening. But the most important thing here is that, here we are mid-January of 2026. If this is the year that you want to begin that, what kind of steps do you need to take right now to start to do that?
Well, one of the first things that I've always talked with clients there is just understanding what your assets are at. And then the second thing is, what do you want to have done with those assets? So it's not really always a fun conversation to have, but it's one of those necessary ones of, hey, when we pass away, what's going to happen to all our stuff?
Mm-hmm.
And if you already know what's going to happen, then we want to see, is this going to make any effect for estate tax purposes? If it does, then how can we go about doing this in a more tax efficient manner?
Right.
So one of the things that grandparents these days are helping out a lot more are 529 plans.
Mm-hmm.
So this is also a great way that we can get money out of grandma and grandpa's estate to help out the grandkids with education expenses. Now, most of the time when we talk about 529 plans, we're thinking about those going to college. However, with new laws, they have now opened that up for kindergarten to 12th grade for private school tuition, some books there as well. The limit just went up to $20,000 per year that a 529 plan can use for K through 12. So again, a lot of good ways to go about there to help plan for education. As far as getting money into the 529 plan, grandparents can front load 5 years worth of gifts. So we just kept talking about the $19,000 without having to do anything and not
Right.
pay any type of gift tax or use it any part of your exemption. You can do 5 years worth. So again, we're going to be looking at $95,000 in total that you can put into a 529 plan. And with that, you still wouldn't hit any of your exemption as long as you outlived that 5-year life afterwards.
Mm-hmm.
Kim, the key is what you and I talk about every single week is to have a plan.
Mm-hmm.
Are you having these types of discussions ongoing throughout the course of the year and every year, not just 1 year? So whether it is, like Lance was saying, education funding, strategic charitable distributions or donations, if you are charitable, that can open up some ideas. If you're charitable, it opens up tax strategies. And if anything, things that we discussed on an ongoing basis, donor advised funds. There's a variety of ways to do this. It applies differently to different people, and sometimes it doesn't apply. But do you have a partner in your corner that's going to have these decisions? You can already tell just by the conversation. Lance loves to explain things.
Mm-hmm.
And again, not only on the radio, but to his clients and to our Haven clients, to have an understanding of why they're doing it, why they're not doing it this way, and avoiding those negative tax surprises. We're coming into tax season. We're going to hear the same ones over and over. Oh, my goodness, I owe more money this year. Why do I keep owing money? Why not fix the problem so it doesn't happen every single year?
Right. So here we are in mid-January, folks. And if this resonates with you, if this strikes a chord each year, as Larry says, you get those taxes back and you owe a big check, you get them back from your preparer, then maybe it's time to sit down with a tax plan. And if you're someone who has thought, I absolutely have got to get an estate plan put together, then 2026 is the year you want to do it. And a great partner to do it with would be the folks there at Haven Financial Group. 612-504-8400. That is the telephone number. Give them a call. Tell them you heard us here on the radio and you'd like to set up an appointment. Again, it's 612-504-8400. Let me get that again. 8400. When we come back, we want to talk about inherited IRAs and the 10-year rule associated with them. This is the Haven Financial Group Radio Show.